Hello everyone. I will continue with chapter 1 in this lecture. So in the previous lecture, we looked at different types of investment, the investment process per se. Now we will look at investment plan. So investment plan means we will come up with a roadmap to follow a disciplined approach and manage our money. The idea is to generate returns and avoid any unnecessary risk. So what are some of the key steps? That is writing an investment policy statement, then considering the tax liability, then thinking about the life cycle over which the investment happens, as well as how to invest along with the business life cycle. So these are some of the key considerations in our investment plan. We will look into each of these aspects in more details. First is writing an investment policy statement. So this is like a formal document where we lay out our plans. So first step is summarize current situation. List the assets that we own. It could be a savings account, equity investments, debt investment, and any other investments. What are the current sources of income and what are the avenues of expenses? And then we have to define our investment horizon. That why are we wanting to invest? Is it saving for retirement? Is it saving for children's education? Is it maybe to buy a house? There are different uh, motivations, and accordingly that will decide our investment horizon. So what is the time taken and what kind of investments we want to do. Then we look at the investment goals. That is, what are the financial objectives we want to achieve? Maybe what kind of returns we are looking year on year, or what kind of risk we want to avoid, and so on. And then is in our investment philosophy. So this is about our risk appetite. If we have low risk appetite, that is we are risk averse, then we will invest in low risk investments. If our risk appetite is more, then we will invest in high risk assets in the anticipation of higher returns. So investment philosophy is more about understanding our risk appetite, and that will have a bearing on our overall investment plans. What kind of investments we do, what kind of time frame we are ready to accept, and so on. Then set investment selection guidelines. Like what is the maturity or time frame that we are looking at? If we have any ethical considerations, or if we have any preference for investing in certain sectors or avoiding certain sectors, investing in certain foreign assets, not investing in certain foreign assets, and so on. And finally, we have to assign responsibility for selecting and monitoring investments. So we can do the selection of investments ourselves or assign it to a professional manager, and also how to monitor whether the investment decisions are on track to achieve our goals. Next is considering the tax liability. So we have to pay taxes at the federal, state, and local level. And the taxes are mostly on income, sales, and property. So income tax can be based on ordinary income. So ordinary income is of three types. Active income, which is from wages, salaries, and pension, basically from our employment. Portfolio income is income from investments, things like interest, dividends, capital gains. And then we have passive income, that is income from special investment, maybe rent from real estate that we own, or royalties from any intellectual property, and so on. So the ordinary income is taxed at progressive rates based on our income. We have incremental increase in tax rate. So this is how our taxable income is taxed for individual as well as joint returns. So different tax slabs for different levels of annual income. Next, we look at capital gains and losses. So capital asset is a property which is owned and used by taxpayers. So it could be securities or it could be any real estate or other property. Capital gain means the appreciation in value. I buy an asset at a certain price, the price increases over a period of time, and because of which I have capital gains. If the capital assets are held less than 1 year, then they are taxed at ordinary income tax rates. That is the marginal tax rate. If the capital assets are held more than 1 year and then we sell off the asset, then our capital gains is taxed at special rates, different rates for different annual income. For high income individuals, they also have to pay an additional tax on capital gains, which is called the Medicare tax. Capital loss means whatever we have invested, the price of the asset decreases and we suffer a loss. So we can offset our capital losses against the capital gains that we have earned, or we can also offset some of the capital losses against ordinary income, which is taxed at progressive rates. So this is the long-term capital gains tax rate at different levels of income. If it's short-term capital gains, that is less than 1 year, then it is taxed at the ordinary income tax rate. So what is tax planning? Tax planning means looking at our current and future earnings and coming up with a plan to either defer or minimize taxes. So we have certain investment schemes which help us in this regard. For example, we have employee-sponsored plans like 401k, where we are not taxed at the time of investment, but when we withdraw our investment after maturity or after retirement, then we have to pay taxes. Roth IRAs, similarly for IRAs, but Roth IRAs are slightly different. So in this case, we pay taxes and our after-tax income is used to invest in Roth IRA, and we don't have to pay any further tax in future, either for withdrawal or for retirement withdrawals. The next consideration is our investment strategy over the life cycle. So every individual goes through a life cycle. So when they are earning in the initial or middle stages of their career, it's more growth oriented. That is, they are able to take more risk so that they can earn higher returns. Then in the middle ages, it is consolidation. This is the period when we are gradually approaching retirement. So in this case, an individual will gradually shift their investment to less risky assets so that there is more surety about the income or more surety about the capital gains. And then we have the income-oriented retirement years. This is from the start of retirement till say, death. So here we have to become very conservative so that we can preserve capital and also ensure a steady stream of income from our investments, which will help us to take care of our living expenses after we retire. We also can consider investing over the business cycle. So every economy goes through a cycle. So a cycle of economic growth followed by economic recession. So during economic growth, we have expanding business cycle, stock prices tend to rise, and stock prices tend to decline during the time of economic recession. Bonds and fixed income securities are also affected by business cycles, because more so by interest rates, because the interest rates also are correlated to business cycle. So whenever interest rate is high, so the bond prices will increase, and it also makes sense to invest in new bonds because we can earn higher interest income. When interest rates are down, bond prices tend to increase. So it makes sense to hold on to our bond investment because we can get capital gains. So these are some of the aspects that we can consider while investing in fixed income. So this is a snapshot of the returns from stocks at different points of time, especially before a recession, during or after a recession. We also considered liquidity in one of the previous slides. So liquidity means the ability to convert investment into cash. This happens because it is very easy to buy or sell the investment. So here we look at the role of short-term investments. So short-term investment means they are of a maturity less than or equal to 1 year, and they provide a pool of reserves for emergency use. So because they are liquid, they can be easily bought and sold. So in case we need quick cash, we can sell our investment and get cash at hand. So how does it work? It operates on discount basis. That is, we buy the security at a low price, and the issuer of security promises to pay a higher price at maturity. So in effect, they are repaying the principal, and the additional amount can be considered as interest income. So the advantages of short-term investment is highly liquid, so it can easily be bought and sold, and it has a low risk of default. The disadvantages are because it is a low risk investment, it also has low returns on average. And if the interest income is not sufficient to cover inflation, then we also are at a loss. So these are some of the short-term investments. So we can keep money in savings account, checking account, and so on. So they earn very little interest income, but the money is readily available. We can withdraw money from our savings or checking account at short notice. Then we have the treasury bills. So these are the securities which are issued at a discount price. So the higher price at maturity is a way to repay the principal along with interest income. Generally, treasury bills are 1 year or less. Then there are certificates of deposits where we deposit the money and we earn interest. Commercial papers are short-term debt instruments issued by corporations. Money market mutual funds are professionally managed funds which invest in short-term instruments. So these are some of the ways in which we can invest in short-term instruments, and some of them are highly liquid and help us to take care of immediate cash requirements. So how does short-term investment helps in liquidity? One is savings. So we invest in short-term investments and we are able to access the funds very quickly. Second is investment. So we have the money easily available and it also provides us some interest income. Let's say the example of treasury bills or certificate of deposit, money market, mutual funds, and so on. It also becomes a component of a diversified portfolio if we plan to invest across different assets. And it is also a way to park our funds if we are waiting to invest in more attractive long-term investments. So till the time we are ready to invest in something which is a long-term asset, we can deposit our money in short-term investments and earn some return or ensure liquidity. So these are some of the short-term investments that we can do: bank account, money market mutual fund, US Treasury bill, certificate of deposit, and so on. Now we'll look at some of the career opportunities in investment. So these are some of the domains of finance where we need knowledge of investment. Commercial banking means lending and borrowing of money. So we borrow money from individuals, and the bank lends it to individuals or uh, companies. Corporate finance means managing the financial operations of a company. Financial planning professionals who help individuals or other entities to manage their investment, basically help them to come up and execute their investment plan. Insurance is about risk management, and investment banking is about helping companies to raise capital for their business operations. Then we have investment management. Those are professional firms which manage money for others. So they run mutual funds. They can also operate ETFs. They can also run hedge funds. And generally, you need the CFA certification for a promising career in this field. So these are some of the career prospects in different domains of finance. The data is slightly dated, slightly outdated, but it gives you an idea about the career prospects. So that's it for chapter 1. Thank you.